Welcome back to the Everything Property Podcast. Now, a few weeks back, I sat down with Renee Romanos, who told a story about how she lost her house in a house fire. Their house was insured for a whopping $300,000 less than it was valued for, and there was a shortfall between the loan and the insurance payout. So it got me thinking, am I actually properly insured? Have I done something similar to Renee and not insured my property for the correct value? Or what am I even insured and covered for? Here to discuss all things insurance as a professional in the industry with 18 years of experience, the last 7 of which running his own business brokerage, in our insurance masterclass with some of the whitest teeth I've ever seen in my life is Dean Bowen from DLB Insurance. Dean, welcome to the show.
Thanks for having me on.
That's all right. Hey, look, mate, thanks for coming on. As I said, I want to touch a little bit on your career and how you sort of got involved in insurance and working up to where you are now running the show. I think the first half we'll talk about home and contents insurance for everyone in there, the investor clients that are buying property. And then the second half, we can talk about home warranty insurance. So everyone that's out there is building and or developing. Hopefully, we'll be able to bring some educational content and to be able to educate people on the topic. So look, run me through it first up, the early days of the career. How'd you get into insurance and sort of where'd you start off?
Yeah, thanks, David. I, like a lot of people, finished school and then jumped into a university degree at Western Sydney. So I managed to get myself into a business and commerce degree. Like a lot of young people, you lose that structure, discipline, routine of school, and you're left to your own devices at university, and you can often find yourself in a little bit of trouble. So my late father, I think at the time, could sort of see what was going on, that, I was doing my studies and then just, pouring beers for a bit of part-time bar work and doing a bit of labouring and just sort of getting by. And I think he thought, potentially I could benefit from a little bit more structure and routine, which, I'd lost by finishing school.
Yeah.
So Dad suggested to me that it might be worthwhile to explore getting a job with a bank, a superannuation company or an insurance company, and then maybe looking at studying sort of part-time and getting some experience under my belt. And he always said, mate, a big company will look after you and give you opportunities. So started doing a bit of research, and I spoke to this mate at university and said, my dad's got this stupid idea that, I should get a job in my chosen field of business. And he'd actually told me that he formerly was employed at an NRMA call centre, which was located in Hurstville. So it's about 10 minutes up the road from where we were living at the time in Lugano. Mm-hmm. And they had this really good arrangement called flexible work team. So it was sort of 4 till 9, 5 till 10, so some afternoons and evenings, and a bit of work on the weekend, 20 odd hours a week. And full of university students and also mums that were, supporting the family by working after hours as well. So he put me in touch with the right people. I went and had an interview and got offered the job. 6 months in, they sort of sat me down one day and called me in the office, and I thought, what have I done? I've done something wrong
I
here.
can see where this is going.
I'm in a lot of trouble here.
Sounds. You tell them your story, my story. Yeah, go on.
No. And anyway, they just sort of said that they were quite happy with how things were going, and they were aware that I was, completing a commerce degree. They offered me a really good opportunity to sort of dial up my work hours to almost like 38 hours a week, pull back on my university, and they said, if you want to do this, we'll foot the bill for your tuition. So you pay for your studies up front. When you pass, we'll give you the money back. Oof. And I was like, so I went home and spoke to the old man and said, I've put this offer on the table. And he sort of said, did you sign anything? I said, well, no, I want to come and talk to you first. And he said, well, mate, I'd be going back in there tomorrow and signing that if I was you. So then I did that, progressed up through the ranks. A couple of years later, I moved on to CGU, which is still part of Insurance Australia Group. Was dealing with the business insurance side of things, the intermediated side of things, dealing with the brokers, as opposed to NRMA, you're dealing, business to consumer. Yep. So went there, managed some claims teams, again, got a really good opportunity to move into account management, business development. So I had like a panel of brokers that I serviced, did that role for about 5 or 6 years, and then sort of got to about 2016, 2017, got to that crossroads of, well, what do I want to do? Do I want to stay here and keep climbing the corporate ladder and move up, or do I potentially want to go out and do something for myself? And after a lot of soul searching and speaking to the right people, I made the decision that my path was going to be better served doing my own thing. Mm-hmm. So left behind a stable, steady job and paycheck every single week, and then started DLB Insurance and Risk in early 2017 with 0 clients. And
so no clients, nothing lined up, and
No.
you just went, I know I need to start this. I'm going to bite the bullet and jump.
Yeah, I had a little bit of consulting sort of work that would keep me going. But it was on a contract basis for my AFSL holder for sort of the first couple of months to help that income come in whilst I was building it. But that was only a very temporary sort of thing to support me early on. There's a lot of sleepless nights, a lot of probably a lot more worse days or bad days than there were good days. But again, here we are 7 years later. Got an office in Caringbah, 7 staff working underneath me now. We've acquired a portfolio based in Melbourne as well a couple of years ago. And yeah, it's all going good.
What are some of those lessons that you learned from your younger years? Like, when does it start to pick up in the 7 years? Is it after the first year, 2 years, 3 years? Or like, when did you sort of start to say, this has got some legs, this is, I'm happy I did this?
I think it took me about probably 12 to 18 months to replace the income, I guess, that I'd lost. I replaced my salary.
Yep.
And I think when I realized that I'd done that and the phone was still ringing, that was sort of, I guess, the point where I realized, well, you've made it now. You don't have to go back to CEDU and ask for your job back, because you're paying your own way with what you've managed to put on. Everything else now is a bonus. Mm-hmm. So, then sort of 2 years went by, and then 3 years, and then I thought, well, now you're actually that busy that you're working 60 odd hours a week, you probably could do with some help.
Yeah.
So then putting on your first staff member on a part-time basis, and then it just sort of scales and I guess grows from there. So
7 full-time staff at the moment?
Yeah.
Perfect. And is there any goals that you want to build out to, or it's just to keep going every day as it is? You're going out to, the millions of listeners and viewers on the Everything Property Podcast Network. So no doubt you're about to explode after this, but what is sort of just see quickly the end goal?
I think now I've, realised what I need to do to scale the business and how I can do it in terms of how to build a portfolio. We've got some really good junior staff coming through, so showing them the path in terms of you're going to work now towards having your own portfolio. And for that to happen, you're now going to, work with me on a lot of these new business opportunities. So I've got that, I guess, methodology in terms of how to scale and how to keep growing. Mm-hmm. I don't have realistically any limits on sort of where it's at. I look at other really good brokerages out there like Warren Saunders, who are a brokerage based in Kirrawee, a family-owned business that's been around for over 60 years. I know the directors there and a lot of the senior management there. I've got the utmost respect for a business like that. I think they've got 80 staff,
wow.
I think, across all their various sort of divisions.
Mm-hmm.
Getting, I admire a business like that, and sort of getting to that sort of level, and as well as some other brokerages sort of, I guess, around me. But no, I haven't put any sort of limits on what I can achieve. I'm just really enjoying the process, really enjoying growing the business and what I do every single day. And like I said, I've got the right people and the right structure now, and it's taken 7 years to get there. So now it's just keep on going.
Perfect. We'll love to hear it, and I can't wait to see sort of what that grows and turns into. If you're looking at something that's 60 years of business, well then, 53 years to come to get to that stage. But look, run us through the purpose of today. We want to have a insurance and home warranty masterclass. So if you can, sort of in your words and your understanding, what is home and contents insurance and landlords insurance? Who needs what? How do they work? How do they sort of differ between them?
Yeah, sure. So obviously I wanted to come on here today to talk about both home and contents and landlords insurance. And I think there's some misconceptions around those particular products, particularly at the moment. So I wanted to clarify, I guess, a few things. And I think, one of the key things that's, I guess, in the media being spoken about at the moment is affordability when it comes to insurance.
Yep.
And there's a huge misconception at the moment, well, it's been around for probably a good part of a decade, that insurance companies make all this money and line their own pockets and don't pay claims, and they've got huge profit margins, when that's actually just not the case. And
I think that's the banks.
Yeah, that's probably the banks. Yeah, especially at the moment with interest rates.
Yeah.
But Yeah, there's been, I guess, this whole common misconception around that. So I wanted to talk, obviously, around assured insurance affordability and what have you. But I guess to answer your question, home and contents insurance is designed for mums and dads and individuals that own their own home or their own property.
Mm-hmm.
So like me, I own my own home. I insure the property and obviously the contents, everything inside the home. Contents are considered to be things like carpets, curtains, blinds, light fittings, and what have you. You can also purchase contents-only policies if you're living in a strata title property. So you might live in a unit complex or you might be renting.
Yep.
And you just purely insure the contents, so what you own within that property.
So just quickly, contents is anything that can be removed. So that's flooring, lights, and like fixtures.
Yeah, so carpets, curtains,
carpet
blinds.
counts as
Carpet, curtains, blinds, light fittings, those sorts of things are generally considered to be contents. Obviously, fixed things, fixed items are generally considered to be part of the building, so they would fall under the building sum insured. And then obviously you've got landlords insurance. So with landlords insurance, you tend to insure if you say owned an investment property that was a freestanding house, you would have the house insured for material damage or accidental damage under the policy, as well as all the additional coverages that relate to exposures of owning a property and having a tenant in there. So malicious damage to the property caused by the tenant, rent default if the tenant sort of ups and leaves and disappears, but also loss of rent too. If that property burns down and you've got it as an investment property, you rely on that rent coming in every week to pay that mortgage. So you need to insure that rental income for a period generally up to about 2 years, so that if the property does burn down, you're insuring that rent that's coming in every single week that you're using to pay that investment loan.
Okay, and if I'm either a landlord or I'm coming to I own a house, how are you advising how much for people to cover or take out for contents? Because a lot of people out there aren't going to know what the carpets and the lights and all that sort of costs. So how does someone get to what their contents cost is going to be?
Yeah, look, this is a huge issue, I think, amongst the broader insurance industry at the moment. It's under-insurance.
Because the lower my insurance, I know there's people that have a lower sum insured, so their premiums and what they need to pay, the yearly amount that they need to pay is low.
Yeah.
But should anything happen, they're obviously caught out long run, right? Yeah,
there's a number of ramifications too. Obviously in the example that you shared, when there's a total loss, like they're $300,000, underinsured, and they find that out the hard way. What a lot of people probably aren't aware of is what's called the underinsurance clause or co-insurance clause. So if you say underinsure your property, and it's under 80% of what it realistically should be. So if it's worth $1 million and you've insured it for $750,000, for argument's sake, to rebuild, what people don't realise is if in the event of a claim, the insurer obviously flags that, if it's a partial loss, let's say you've got some storm damage to the roof of the property or what have you, the insurer will actually diminish the amount that they pay under that claim, because the way that they essentially view it is co-insurance clause, that you are co-insuring that property, or self-insuring that property to a degree. So they will actually reduce that amount. If there's $100,000 in damage to the property, depending upon obviously the level of where you're insured, what value you've got under your insurance, they're not going to cover that full 100K. They will actually apply the co-insurance clause or under-insurance clause and reduce the amount that they actually pay under the claim, because they then take the view that you are self-insuring a part of that risk yourself, and that you've therefore, in the event of a claim, you're contributing part of that loss out of your own pocket.
Wow, but how are people going to know, and for it to be accurate? Is it like a quantity surveyor, or?
Well, there's a couple of ways. So,
do you guys advise that service?
No, look, we're not qualified property valuers, so we actually can't give advice in terms of what people should be insuring their properties for. In saying that, online there are a number of really good calculators that people can use. There's one on the Insurance Council of Australia website that will assist homeowners calculating the value of their property. So the calculator obviously asks a number of questions around building materials that have been used, how many bedrooms, how many square meters, all that sort of thing, and then it will give you an actual value or an idea, and you can obviously work off that. In the absence of that, however, there's always, you can go down the path of obtaining an independent valuation from a qualified valuer
Mhm.
as well. But, you know, these calculators, I'd tend to say that's what the majority of people are probably doing or the people that are aware are probably going online and looking at those. But I guess what a lot of people probably don't appreciate is the cost of building materials and how much that's gone up over the last couple of years. People aren't actually having a really good think about, well, you know, my home's been insured for $500,000 for a number of years, and every year the insurer incrementally increases the value by a small percentage. But given that stiff rise in the cost of materials and labour shortages and what have you, and, you know, which I know that you've discussed several times in this podcast, people I don't think are being proactive enough in sort of, I guess, addressing that and exploring that and, you know, taking upon themselves to explore those, you know, go online and utilize those calculators.
Okay.
And I guess for us as insurance brokers, the onus is on us to make sure that we're having that conversation and documenting that conversation with our clients, you know, around go and get a valuation or, you know, at least jump on and have a look at this particular calculator as a minimum. Yeah.
So if someone's listening to this and they think, shit, I want to check that, your advice to them would be jump on board.
Yeah, online. The Insurance Council of Australia has I think probably the best one. There's a number of them on there. Some of even the direct insurers have their own, I guess, calculators that will assist people. But I tend to find probably the Insurance Council of Australia, it's an independent one as well. So, you know, jump online and obviously double check that. And again, if ever in doubt, contact your broker or, again, engage the services of a qualified value. It might cost you a couple of $100 or $1,000 or something like that, but you'd much rather that than, you know, be in that unfortunate predicament that, you know, where you've suffered a total loss to your property and you're a couple of $100,000 underinsured.
So tell me though, with is how an insurance broker gets paid similar to how a mortgage broker get paid? Do you get paid by the client that comes to you and pays you, or do you get paid by the insurance where your client takes the insurance out from?
Generally, the way that a general insurance broker is remunerated across both personal lines products and obviously commercial products are what we do for businesses, it's somewhat of a hybrid model. So there is a commission that's paid by the insurance company, but there's also generally a broker fee that's applied as well, and you make your income, I guess, on that hybrid model. But again, with all the challenges around home insurance, like just before I came onto this podcast, I was reviewing a renewal for a client. Now, he's got a specialised policy because he's a high net worth individual, and the sum insured under that property is in the millions of dollars. That particular insurer doesn't pay commission to brokers on that policy at all. So you've got to obviously charge the client a fee to manage that policy. We've noticed as well in the last couple of years, insurers sort of come and go in terms of they've ceased offering household insurance.
Yep.
And also a lot of them have, you know, not taken the hard line of taking away all commissions, but significantly reducing the commissions that are paid to brokers.
Yep.
Purely because of bottom line and profitability on their house and contents and domestic lines portfolio. And I guess their message is pretty simple. It's either we did this or we exit the market altogether.
What happens if you've got a policy out with like a random company, ABC company, and they either stop offering that altogether? Do they still honour your current policy and don't open that to other new customers, or what happens?
Yeah, that's essentially what would happen. So whenever an insurer exits a portfolio, whether it be home insurance or any form of business insurance or what have you, they will then advise the broader market that as of this particular date, they have ceased offering new business. And then they give you there's a 12-month period where then obviously everything that comes up for renewal is then in term cancelled, and you must find another home for it. So I know later we're going to get on to construction insurance, but Vero a couple of years ago did this on their contract works and liability. Vero were a decent player in the construction market, and then they exited the construction and liability market altogether a couple of years back. So they advised as of a particular date there was no more new business. They'd obviously happy to do endorsements and changes and what have you, but as the years sort of went on, you were having to find homes for these policyholders.
Jesus.
Yeah.
Okay, so just on home and contents landlords still, is there any tips, tricks, or any secrets that you can share sort of for everyone listening, whether it be for home and contents or for landlords insurance that they can do, I don't know, to get the best rate, or that they might not know, not being a broker? Is there anything you can sort of share with people that any value there?
Yeah, of course. I think at this particular point in time, obviously household insurance, house and contents landlord insurance, domestic property insurance has significantly increased over the last couple of years, and it is quite unaffordable. The other difficult thing in New South Wales that not a lot of people realise is that we still fund the emergency services levy through a taxation on insurance, and that's commercial property insurance, domestic property insurance, construction insurance as well, which again contributes to insurance unaffordability and costs. So I think people just need to understand that that's actually being looked at the moment by the New South Wales state government. They were meant to abolish it back in 2017, but backflipped at the last minute. So just understanding that is to come, and there is probably a little bit of relief in sight. I think obviously we've spoken about the usage of those calculators and making sure that you are insured correctly. But when it comes to, I suppose, pricing, you might want to consider looking at higher excesses under the policy as well. So looking at, instead of a standard excess of $500, could you potentially explore an excess of $2,500 in the event of a claim, in order to potentially offset some of that premium increase? Pretty much all insurers and all brokers offer monthly payments as well, so that might assist from a cash flow point of view, rather than having to part with all of that premium up front. So they're probably the two main things I'd say is look at the monthly options, as well as looking at higher excesses under your policy as well, if you're looking at costs. And obviously, again, just understand that the emergency services levy, it is on the radar of the state government at the moment to look at a fairer system, that's sort of consistent with other states within Australia.
Yeah, because if you ask for your breakdown, you'll see that line item in there. It might be a couple of $100.
Yeah. Yeah. And I think the thing is as well, a taxation on insurance, what it means is that policyholders are the ones that are paying that particular levy. So those people that choose to self-insure don't pay that levy at all. However, in the event that their house catches on fire, they're still entitled to be able to call the fire services or SES in the event of a storm. You're not going to call them and they say, mate, you don't insure, so we're not helping you. Like, they still obviously have access to those services, so they should contribute to the cost of those services, which I think in other states they've looked at it's paid as part of your council rates, which I know, I think we're looking at doing sort of in New South Wales as well.
Okay, perfect. Well, look, I'm totally across it. So can you explain the relationship between the premium and then your yearly sort of repayments and how that works, lower and higher? So
if you look at increasing your excess, so again, most standard house and contents or landlords insurance excesses are probably going to start somewhere in the vicinity of $500.
And what's excess?
So an excess is the amount you pay towards a claim. Okay. So if you need to lodge a claim. So potentially as well, like if you're someone that hasn't made many claims or any claims under your house and contents insurance, and you might be able to again offset some of that increase in the premium or cost in that premium by electing to take an excess, say up to $2,500. That potentially again can offset some of that and reduce both the annual and the monthly installments for the insurance.
Okay, perfect. So something for people to have a look at in the online calculators or something like that, right? To put in a high premium and.
I think it's more like if you're the online calculator will just simply tell you what your property is technically going to cost to rebuild.
Yep.
I think the excess options, whether you utilise the services of a general insurance broker for your house and contents insurance, or if you actually purchase it direct from the insurer, it's have a conversation with your broker or have a conversation with your insurer. Ask for a couple of options. Understand. Well, if my excess is $500 or $1,000 or $1,500, $2,000, $2,500, or as high as it can go, or as high as you're willing to take on. Just understand what your options are and ask for a couple of options. Understand the difference in cost and how that sliding scale works. When the excess goes up, how does the premium sort of come down? So just ask for those options.
Okay, perfect. That's great advice. Let's jump into now home warranty insurance. Give me your best explainer. breakdown.
Yeah. I could sit here and talk for hours.
Hey, that's what we're here for, huh?
We
should start a podcast
just on New South Wales home warranty insurance. So New South Wales home warranty insurance, and again, I'll have to summarise this very quickly because I could go on off a lot of different paths.
Yeah.
What is it? It covers a homeowner in the event of like a build or renovation that the builder dies, disappears, becomes insolvent, or has their builder's license cancelled by Department of Fair Trading. So it will cover them, the homeowner, if that happens throughout construction, but also post-construction up to 6 years for major defects, if obviously the builder's no longer around to come and rectify defects and issues and what have you. So legally speaking, a tradesperson or builder must take out that insurance for all works that are undertaken in New South Wales over a value of $20,000. So by the letter of the law, it must always be taken out. The builder takes it out, and the homeowner is obviously the beneficiary of that particular policy.
And does the homeowner get shown the...
Yes.
Okay.
Yeah. What you're tending to find now as well, post-banking Royal Commission, that you will need to demonstrate that the home warranty insurance has been taken out
and in place
in order to get your construction loan. Yeah.
Okay. Well, there's a lot of builders that are going. I talked about it with Sam Lambert a couple of weeks ago. There's a lot of builders going into administration and stuff like that.
Yeah.
If you have home warranty insurance taken out, are you covered then if that builder goes in administration?
Yes. So if the builder becomes insolvent or goes into administration, so let's say you're halfway through the construction of your new home, and the builder goes under. There is a bit of a misconception though about what's actually covered. So there's a few things that you need to keep in mind. The maximum amount claimable under a policy or dwelling is $340,000. So if you've got a duplex, it's $340,000 per dwelling, but if it's a new home, it's only $340,000. That's the maximum amount you can claim under the policy.
Interesting. Why is that?
Just legislation. Just legislation. Yeah.
Okay, so if you've got a really expensive home build, and the builder's only just started, went under, you're going to get $340,000.
Yes. Now the other thing too is that you need to understand it's the cost is essentially only there for works that have been paid for but not yet completed. So like let's say you look at a standard construction contract. So knowing this, obviously having just completed my first development, you've got your deposit stage, then you pay when the slab's been poured, framing's up, waterproofing, basically lock up. So when you're paying, let's say, the progress claim after the slab's been poured, like a lot of that's obviously to probably pay the concreter, but a lot of that then would go towards framing as well, and it goes to to pay for that next stage that's to come. If you pay that then and you look at your progress claim, you're only going to be able to claim for, and clearly, that you've got to be able to demonstrate, well, I paid a progress claim of, let's say, $300,000, but 150 of that was for framing that was to come, and the builder's gone under. So 150 relates to prior works. It might be some of the, concreting and other bits and pieces that have gone on, but it's essentially you're only claiming for works that have been paid for but not yet completed. So in that instance, you're not guaranteed 340,000.
Yep.
You might only get 150. The other thing too to keep in mind is let's say the builder goes under and you're in a fixed price contract to build that home for $1 million. And like we've just seen with obviously material shortages and costs and what have you, you get other builders in to come in and have a look at it, and they say, well, you might have had $500,000 worth of work to go if you're halfway through it.
Yep.
Next builder comes in and says, well, mate, I can't do that for any less than $750,000 or $800,000. You're up for that extra $250,000, $300,000. That's not going to be covered under home warranty. The additional costs associated with someone else coming in to do it is not something that you can claim under the policy. So there's a lot of misconceptions about that. And I think what homeowners have always got to be aware of as well is that it is a last resort policy. You cannot, if your builder's alive and well and trading, you can't claim under that policy at all. You've got to go down the path of, ANCAT and fair trading and what have you. If there's these disputes, you can't just claim on it if the builder's, again, alive and well and kicking on.
Wow, so they have to go insolvent. They have
to very much go insolvent. Yeah. Yep. So
Jesus.
Again, it's a bit of a misconception, but I suppose that's why we're here. It's for these people that are looking to maybe do these developments and, build a duplex or what have you, to actually understand what that insurance covers.
Okay.
Yeah.
And say you were saying you've done your first duplex development. Dean, you go out, you build the duplex, the builders, you get the home warranty insurance for 6-7 years. You then sell both sides of that duplex. What happens to the insurance to make sure that building is okay for the next 6 or 7 years. Does that then get passed on to?
Correct. So the new owner becomes a beneficiary. So obviously one of my duplexes is up for auction this Saturday. So in the event that it's hopefully sold, the new owner will become the beneficiary of that particular policy. And what you tend to find is that, solicitors and conveyancers are well aware of these sorts of things. So a copy of the home warranty insurance is already in the contract.
Okay. And who's responsible for updating that?
Updating that?
The insurance to show that the new owners.
Oh, it doesn't matter. It doesn't matter.
Okay.
No, it's always there's home warranty insurance on that particular property. So in the event that something was to happen and the homeowner needed to claim down the track, they'd be able to demonstrate clearly that they purchased the property from me, and that home warranty insurance was in place. It was completed on this date, and it's quite, that doesn't somewhat become an issue. But yes, they become the new beneficiary of that particular policy.
Okay, and is there anything else that we should know about what we can and can't claim for under this home warranty insurance?
I think I've obviously outlined that around, that there's only so much, I suppose that you can realistically claim for. But again, I think, there's nothing probably extra to add, but I think a lot of people, and I've sort of seen this over the years with, that people sort of tend to think that, well, there's all defects throughout the property, and then they try and lodge a claim under the policy and they notify iCare of the claim, and it just gets pushed out and they just go back and say, well, no, you need to go and speak to the builder. So just always, guys, remember that it is a last resort policy. And it obviously is as well contingent upon your build cost. So it's not a flat fee, even though the amount that you can claim is only $340,000. If you're building a duplex and your build cost is $2.5 million, say for argument's sake, well, you're going to pay a lot more for the warranty insurance than someone who's building a project home getting those duplexes completed for 1.25 or half that amount. So the premium is relative to the actual the build cost too. So just to keep that in mind, I think it's probably one of those things, I guess, as a homeowner or someone that's looking to do their first development, to always keep in mind it's probably one of those costs that you don't think about, and maybe something that you don't budget for. There's always calculators online that can tell you the premium as well. The only thing that you probably don't account for is a loading and discounting system for the builder, depending upon how they operate financially and the financial health of their business too. But if you ever have any questions, iCare are always happy to speak to homeowners as well.
Do you have any rules of thumb or any examples of how, depending on the contract price, what the insurance might cost?
It's hard because of that discounting and loading as well. There is sort of fixed percentages, I guess, online. But like I said, if you're, let's say, a lot of builders out there, they do a carpentry apprenticeship for 4 years, then they go get their builder's license. They might work for someone for a year or two, and then they say, I'm going to go out on my own. If you're a first-time builder starting out with no company or trading history, you automatically get a 30% loading on your premium. If you're a bigger sort of builder, you've got a lot of, a good track record that's been built up, you've never had any issues or run into, bordered on the line of insolvency or had trading losses, well, you've been going for, 15 years, well, you're probably not going to have that 30% loading. You're probably going to be maybe off scratch or even, slightly less, like on a discount. Same as if you're a sole trader as well, because they look at that as, well, there's lot less risk even with sole traders. For them to go under, they basically have to declare bankruptcy. So, it sort of varies, I guess, builder to builder. But always speak to your builder about it if you're ever unsure as well. And like I said, iCare, you can always contact iCare as a homeowner and ask any questions that you might have too.
Okay, and the builder's paying for that policy?
The builder does pay for it, but I suppose, I've seen examples where the builder's paid for it. I've seen the builder send invoices to the client and have them pay for it. It comes out of the client's pocket at the end of the day. It's not, the builder's not going to diminish their margin on the job to pay for the warranty insurance. It's always going to be factored in at some particular point. It can be as well included in the contract. But it always eventually comes out of the client's pocket somewhere.
Talk to me a little bit about defects. You mentioned it before. Is there anything in insurance that can be claimed for, or how is someone to go about, let's say they've got you may or may not know this, but someone's got a homeowner, home builder, just built them a brand new house. They go through, it's riddled with defects.
Mm-hmm.
Is there anything in insurance that they can get or put into place to get those fixed by the builder, or what happens there?
So under a builder's contract works policy, there is generally a 12-month maintenance period or defects liability period. So after practical completion, when a job's handed over, there's that maintenance period will start. Now, what you always have to remember with defects is that the cost to actually rectify and fix a defect itself is never picked up under insurance, or not really picked up under insurance. It's always the resultant damage that's picked up. So if you've got, say, some roof plumbing that's defective, like flashings or what have you is defective, the cost to actually send the roofer back to fix all of that is excluded. But if water gets in and damages gyprock ceilings and carpets and everything else, and there's $80,000 worth of water damage inside the property, that will be covered, but the cost to actually fix the defect itself will not be covered. So that's generally a 12-month, 12 months after practical completion, that your builder will have that coverage.
Okay, and if the builder's not coming back to site and not going to fix the defects, then that's an issue for your NCATs and stuff.
Correct.
Like that.
Yeah, that's then unfortunately got to go down the path of ANCAT. But you know what's funny? I suppose, do you remember a couple of weeks ago in Sydney we had like that 150 mil of rain on a Friday?
I did. I do. Yeah.
I mean, I had some interesting calls from clients, and they just sort of said stuff that they'd built like 5-6 years ago, and homeowners are ringing them saying, well, this is an issue. And then you have those conversations. I had a number of phone calls from different builders, and I think people in that sort of circumstances have to be a little bit more realistic in their expectations. Well, the house has been there for 5 or 6 years. We also had that period of 2021, 2022 when it just rained. We've had a lot of rain over the last 5 years. Chances are this isn't a reflection on poor workmanship or poor building. This is actually the fact that we had a month and a half's worth of rain in the space of 6 hours. Properties aren't essentially going to be able to withstand such amount of weather.
Yep.
So that's what a home and contents insurance policy is for. So,
okay.
Yeah.
Good to sort of split up and see how the two work together.
Yeah.
Just in terms of the building and developing section, is there any other insurances that builders or first-time developers should be taking out that they maybe don't know about?
Yeah, absolutely. I mean, we can just give you a quick rundown.
Please.
And I mean, look, whenever I sit with a builder client, developer client, I always go through everything with them and say, this is everything that could possibly go wrong, and these are the solutions for them. Now, a lot of the time, the builder will, sometimes I'll take all of these policies. Sometimes I might take one or two, or sometimes I might say, Matt, I don't want any of it. And you, okay, well, that's fine as well. But as a broker, that's your responsibility, is to educate the clients. So just to rattle them off quite quickly, obviously, contract works and legal liability. Contract works is going to insure the dwelling whilst it's under construction. So the home whilst it's under construction, if it was to burn down, or if there was weather damage or accidental damage to the property, obviously the defects liability period is under that as well. In the same policy, you've got your public liability. So that's going to cover things like, vibration removal, weakening of support. So if you're excavating a basement down, you're digging into rock and it damages, neighbouring properties, you have a subcontractor that falls off the scaffold, the workers' comp insurer then comes after you, injury to contractors and labour hire. So those sorts of things are picked up under the builder's contract works and liability policy, or construction insurance, or builders all risk insurance. There's a few different names for it.
And is this developer that needs to take those out, or builder?
Generally, the builder will take that policy out on behalf of the developer. With that being said, though, I've seen a lot of examples where you will have what's called a principal control contract works policy. So the actual principal or developer will have the construction insurance themselves, because they want to be able to control and drive that outcome if there is a loss. The builder would then just need to make sure that their public liability insurance is adequate to pick up, and their insurer is obviously aware of what they're doing. Yep. So yeah, it is common, and we deal with that all the time. Where I've got one at the moment where a client's just is doing a massive renovation to a building, a commercial building, and the property owner has taken out his own construction insurance. It's generally more probably common in commercial transactions, commercial development. For residential stuff, generally the builder will just have it under their policy.
Yeah. Okay. Is there anything else?
There'd be a couple of other policies that you need to consider. Professional indemnity insurance. If you're doing I guess, design and construct as well. If you've got in-house design teams, if there's issues with the design, that's not potentially something that's going to be covered under the construction insurance. So looking at that, I suppose other things too that you want to consider, cyber insurance. It's probably a very fast-growing.
Talk to me about that.
So I suppose in the construction industry, so much money is changing hands every single day. So if you're, I guess, a developer or a builder, and you've got contractor payments, material payments, and what have you, if you've been on the tools all day and you're getting home at night and you get an email from your tile or timber supplier that says, hey, you've run up a statement of account, you owe us $100,000. P.S. We've changed our bank details. You might have kids running around, you've just put them to bed, you're absolutely knackered. You don't ever think to check that twice. And by the time you realise that was fraudulent, that money's already in Nigeria. So there's something that's going to cover things like that. And obviously directors' liability too. I mean, worst thing that can ever happen on a construction site is that someone loses their life. So there are policies out there. A management liability policy can provide legal costs associated with like an investigation or prosecution from work cover. Up until June 2020, the policy actually could cover the fine itself. But you remember that unfortunate incident in the city here with the scaffold collapse and killed that young man. The state government passed legislation to prohibit an insurer from actually indemnifying an insured for the fine, but it can still pay the legal costs. And it's important to know, if you've done your own developments and you've built up a lot of, wealth, generally work cover can come at both the entity and also the directors of the entity as well. So, a good idea to consider that.
Yeah, huge. I mean, that reminds me of a little story I had working a couple of years ago. Was one of the accounts team. I think there was one or two numbers that they got wrong on the payment of the EFT. Yeah, sent $60,000 to a random account in Brisbane. Yeah, and it was absolute mayhem trying to get that money back. So there was like people thought that we were hacked and all that kind of stuff. So yeah, cybersecurity is definitely something to look into. Look, to wrap up and leading off your last point with PTY LTDs and directors, do you have a golden nugget that's something that you can share to us with a bit of high value that you can share to the audience that people probably may or may not have heard before, or something that you haven't shared online on socials?
Yeah, sure. So if you're a developer and you're doing your own developments, if you have another entity outside of your trading entity or whatever you want to get yourself into, you need to be very, very careful in how that potentially affects your home warranty eligibility. Okay. So if you liquidate a company outside of your trading entity or it goes into VA and there's creditors involved, automatically your home warranty eligibility is going to be suspended and you're probably not going to get it back if that liquidation or administration goes through. Okay. Even if you close down an SPV and there's no creditors at all, you're still potentially going to attract the attention of iCare, and they will still come to you and ask you what's going on. Even with an SPV, like if the SPV owns the development site and then it contracts the construction work out to the trading entity.
So let's break this down with a real life example with, instead of some acronyms, let's use some business names and stuff. So the people listening, SPVs and stuff they might not know. But so for example, if I had David's Developments, PTY Ltd, I set that up as what's called a SPV, special purpose vehicle. I wanted to do a duplex in that. If I've also got David's Cake Making, you're saying if I shut down David's Cake Making, it's going to raise issues for the development entity.
Yes, if you've got home warranty eligibility in that entity, then yes.
Hang on. Yeah. If I've got home warranty eligibility in the cake making,
no, in the construction entity. So if you're doing your own developments, right? Let's say you're a builder developer doing your own thing, and if the cake making entity just gets closed down voluntarily because you don't want to do it anymore. Generally speaking, if there's no creditors and what have you, and you've just closed the company, then it still will attract the attention of iCare. Wow. They will still ask, send a please explain. Yeah. If that entity, let's say something's happened, something's gone wrong, and you've got to liquidate that entity and there's creditors, and it could be like the ATO, for instance, your home warranty is pretty much gone. So I think the message out there is as well, I think in this day and age, there's all this talk about like side hustles. So, if your mate or someone encourages you and says like, let's start up a craft beer company or a clothing company, or it could be anything. You just got to know what you're getting yourself into. And even if you're purely a shareholder, if you hold those shares in your name and that goes belly up, that's going to affect your home warranty eligibility over here. So the message is, you want to be really careful what you get yourself into and what you potentially look at maybe doing on the side. And again, if it simply just closes down because you don't wish to continue and there's no creditors, chances are it will be okay. You're still going to get a please explain and get put through, a review. But again, if that goes into administration or liquidation or these creditors, it's pretty much game over. So be very, very careful what, bright ideas that there might be out there. Again, beer companies and clothing companies and whatever it is, just be very careful what you want to look at doing outside of construction, because if it goes wrong, it can affect your bread and butter and what you do every single day.
Huge point and a bit of advice to end on, Dean. I really appreciate it. I'll put in your contact details as well in the show notes for anyone that wants to reach out and have a chat. But to end on it, what I've been asking people is, Dean Bowen, what's a quote you live your life by?
Nothing worth having comes easy.
Nice. Love it. Thanks for coming on, mate. Appreciate it.
Thanks so much for having me.
Too easy.